Hi friends, welcome to my YouTube class 11 Accountancy. As we had completed the depreciation chapter, provisions and reserves, the next class is about the bills of exchange. As you know that businesses are dealing with the numerous transactions of buying and selling of goods and services. That buying, purchase of goods, sales, transfer of goods. Obviously, the buying and selling of goods in the business is done on cash basis as well as credit basis. Cash basis, when goods is transferred by the seller to the purchaser or creditor to the debtor, then immediately cash is received. So no problems. The cash is realized. But regarding about the credit transactions, when goods are sold on credit basis, there is a question arises that what is the proof of that the goods is transferred to that sum of persons, the creditor to the debtor, and he will make the payment on a specified date. Is there any guarantee, or can you give any guarantee regarding that payment? Certainly, obviously not. You see the general transactions that when we are taking the लोन फ्रॉम आवर फ्रेंड्स, भाई 5,000 रुपया थोड़ा दीजिए तो हम 10 दिन या 15 दिन के बाद आपको लौटा देंगे। वो भर्ष की चलते हुए दे देता है, लेकिन वो दोस्त पेमेंट नहीं करता है, वो उसके पीछे लगता रहता है, भाई कब दोगे कब दोगे। तो इस ट्रांजैक्शन में क्या होता है ना, दोस्त दोस्त में करार होता है, कन्फ्लिक्ट होता है, लेकिन कुछ फायदा नहीं होता है ना। वो जिसने वो पैसा उसको कर्ज पे दिया था, ना उसको पैसा रिटर्न हो रहा है, ना वो पैसा रिटर्न दे रहा है। अगर उसमें कुछ एविडेंस नहीं है, आपका पास कुछ एविडेंस नहीं है, तो फिर आप कुछ भी नहीं कर सकते हो। क्या करोगे? कुछ नहीं कर सकते हो। ना किसी को बोल सकते हो कि इसने मैंने पैसा लिया, वो नहीं लौटा नहीं रहा है, तो बोलेगा कि हमको पैसा कहाँ दे रहा, कब दे रहा, उसका कुछ रिकॉर्ड है। तो you can just imagine that this type of transactions, numerous transaction takes place by the business. Business does a lot of transactions every day, that credit transactions. आम लोग भी उधार पे खरीद करते हैं दुकान से, वो पैसा महीने के बाद या 10 दिन के बाद या 15 दिन के बाद जब पैसा आ जाता है वो लौटा देते हैं, पेमेंट कर देते हैं। लेकिन कभी कभी क्या होता है ना, दुकान वाले कुछ उधार तो दे देते हैं, लेकिन वो उधार कलेक्शन नहीं होता, तो वो बेड डेप्ट हो जाता है, वो एक लॉस होता है। तो बैंक में आज जो बैंक ट्रांजैक्शन आजकल जो हमारा जो राष्ट्रीय बैंक है, जो नेशनलाइज्ड बैंक है, वो उस बैंक में 1000 करोड़ रुपया जो ट्रांजैक्शंस होता है वो एनपीए में चला जाता है, नॉन परफॉर्मिंग एसेट्स। मतलब उसका कुछ कलेक्शन गारंटी नहीं है, रिटर्न का कुछ गारंटी नहीं है। जो लोन दिया गया है वो रिफंड नहीं हो सकता है, उसमें कुछ प्रूफ है फिर भी कुछ नहीं होता है। तो बिजनेस की बात अलग है। तो बिजनेस में भी क्रेडिट ट्रांजैक्शन होता है, तो बिजनेस भी कभी कभी लॉस सहना पड़ता है। तो इसी की वजह से तो बिजनेस क्या करता है ना, कुछ डॉक्यूमेंट अपनाता है। क्यों ना हम कुछ राइटिंग रिकॉर्ड्स व डॉक्यूमेंट हम बना लें जो क्रेडिट ट्रांजैक्शन करते हैं। When we are selling goods on credit by the creditor to the debtor, suddenly the creditor makes a document, the debtor makes promise, I will pay you, no doubt। तो उसमें कुछ प्रॉब्लम नहीं है, हम एक डॉक्यूमेंट बना देते हैं, जो डॉक्यूमेंट में आपका राइटिंग में रहेगा कि आप इसी डेट को पैसा आप दोगे। तो उस डॉक्यूमेंट को हम लीगली तरफ से भी कानून कार्रवाई कर सकते हैं। अगर वो उसी डेट पे पेमेंट नहीं करता है, डिफॉल्ट होता है, तो हम कोर्ट पे जा सकते हैं, केस भी कर सकते हैं। तो ये आपका जो ट्रांजैक्शन है वो ट्रांजैक्शन आपका सिक्योर हो जाता है, तो आपको गारंटी आ जाता है कि नहीं, हम ये ट्रांजैक्शन हमको मिल जाए, ये पैसा हमको मिले। तो उस जो डॉक्यूमेंट हमको जरूरत है वो डॉक्यूमेंट, देयर आर 2 टाइप्स ऑफ डॉक्यूमेंट वी यूज जनरली फॉर क्रेडिट ट्रांजैक्शंस। So those 2 documents are, one is your bills of exchange, another is your promissory note, both the documents are in writing containing unconditional order, making the payment by the debtor to the creditor, but in writing and in the evidence with the legal documents that if the debtors will not pay or debtors is a fault in making the payment of the particular amount on a specified date, then the creditor can take action, legal actions. That's why it is a legal document. So these two documents are, one is your bills of exchange, another is your promissory notes. These two document is prepared and it is come under Negotiable Instrument Act 1881. So these are the two important documents. So let's discuss about the bills of exchange. What is bills of exchange? What are those features? How it is prepared? And the second one, that is the promissory notes. What is the promissory notes? What are the parties are involved? How it is prepared? Who prepared it? Let's come and discuss clearly. Let's begin with the meaning of those two documents. First is your bills of exchange. Bills of exchange is a document, negotiable instrument, prepared writing unconditional order to make certain sum of money to a specified person on a specified date. So that is the general meaning of the bills of exchange. If you see the definitions of the bills of exchange as per Section 5 of Negotiable Instrument Act 1881, the bills of exchange can be defined as a bills of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person. That means it is prepared by the maker, signed by the maker, directing to a certain persons to pay the certain sum of money. What is the amount of money? And he is direct to pay certain sum of money only to or to the order of a certain persons or to the bearer of the instrument. Either to the persons mentioned or to the bearer of the instrument who holds this instrument. So in detail we can say the bills of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay certain sum of money only to that persons or order to a certain order to of a certain person to the or to the bearer of the instrument, either to the specified person or to the order to a certain person or to the bearer of the instrument who holds this instrument, bearer. So that is the bills of exchange. Meaning, let's see that what are the features of the bills of exchange. The first feature is it is a written order, written unconditional order. It should be in writing. Without writing, nobody will accept. So that should be in writing. Then second feature, it should be drawn and signed by the maker. That means drawn means prepared. That bills of exchange should be prepared by the maker. Who make the bills is called maker, and he should sign. The bills should be signed by the maker also. Then it is a valid document, and the maker is none other than the creditor who sells goods on credit. He is the maker. He will sign it, prepare it, then it will be given to the debtor. It is an unconditional order to a person. Unconditional order. It is an unconditional order is given to the persons, particular person, to pay the certain amount. So that is the drawing. That means the debtor. That specified amount should be specified. What is the amount? That is clear. Then specified period or the date. That period must be mentioned. How much date, how much month, how much periods, days you need for the making of the payment. Then sixth is it should be accepted by the drawee to make the legal documents. That means you had prepared, the creditor had prepared, signed, specified the amount, what is the amount, what is the date, specified the period or the date on which it is to be paid and where it is to be paid, then it should be all those conditions should be accepted and signed by the drawee or the debtors or the person who makes the payment. So that should be signed. It should be accepted by the drawee in order to make a legal document, valid document. If the drawee will not accept it, you had sold goods to the debtor and the debtor does not accept your document, then certainly there is a problem arise. That means that document is not a valid document. He should agree and sign it. Then it is a bills of exchange. Let's see the specimen of bills of exchange. At the left corner, it should be top at the written, it should be written amount of the bills. What is the amount of the bill? Then stamp should be there that to make a valid document. Then in the right corner, at the top right corner, that is the place, the date on which the bill is to be prepared. Then it should be written 3 months after date paid to Ramesh. I have taken the persons Ramesh or order, either Ramesh or order. The sum of 50,000, that 50,000 is mentioned, 50,000 only for the value received. This is a bill. And at the right end, right corner's end, bottom, it should be top, it is the place date, at the bottom it should be signed by the drawer who prepares the bill. That means signed by the, suppose it is prepared by Suresh. So Suresh and Company, New Delhi, and it is accepted by the debtor to whom order is given for the payment. So that is accepted and signed by the Rakesh and brothers. Suppose Rakesh and brothers. I have taken as an example here that Suresh sold goods on credit to the Rakesh brothers for 50,000 and he gives the order to make payment to the party, to the Ramesh. That is the Ramesh is the third party to whom payment is to be given, and the creditor is Suresh and Companies. The debtor is Rakesh and brothers. So Rakesh and brothers will accept it, sign it, then it will be a valid document. So 3 people are involved. This is the first one, this is second one, and this is third one. These are the 3 parties are involved. So that is the parties to the bills of exchange. There are 3 parties are there. First party is your drawee or the creditor. Creditor is here Suresh. He is the first one. Then second is the drawee or the creditor or the maker. He is the maker of the bills. He will prepare the bill. He is called the maker or the drawer or the creditors. Then second one is your drawee or the debtor. Debtor is here. That is second person, second party. That is the who purchase the goods on credit and he will make the payment. So he is the debtor or the drawee. And third one is your payee. Payee is the person who receives the amount. So payee is none other than the drawer. Payee is same as a drawer if third party is not involved. Since here third party is here Ramesh, so he is the payee. So Ramesh is the payee. He will receive the amount. Drawer is the Suresh or the creditor, and debtor is the Rakesh or the drawee. Drawee make the payment to Ramesh, who is payee, and it is given order by the Suresh, who is the drawer. So these are the 3 parties to the bills of exchange. So let's see, there are 2 types of bills of exchange are there. One is your trade bill and another is your accommodation bill. Trade bill, that means the bill which is used for buying and selling of goods transactions. That is called trade bill. So in those cases, example that A sold goods to B So in those cases, the trade bill is used because there is a purchase and sale of transaction takes place. So in those cases, A will prepare the bill in the name of the B. B is the debtor and A is the creditor. A is the drawer, B is the drawer, and A is also paid. Here third party is not there. So that is the trade bill. But accommodation bill is the bill which is used for some mutual help. That means just to giving you example, पहले जो example मैंने आपको दिया था, मुझे 10,000 रुपया चाहिए था, मैंने अपने दोस्त को जाके बोला थोड़ा मुझे 10,000 रुपया दे दीजिए, मैं आपको 10 दिन के बाद लौटा दूंगा. So that is for mutual help. There is no transaction for buying and selling of goods. So to make the proof of that transaction, we prepare a bill. This type of bill is called accommodation bill. That is for mutual help. So we prepare a bill that is called accommodation bill. So these are the two types of bill. Generally, the trade bill is used, which is to be for our discussion, and accommodation bill is not in your syllabus for class 11 accountancy. That accommodation bills is not there. So when you go for higher studies like graduation or some professional courses, Dr.R.K.BAL accountancy, cost accountancy, or some other courses that graduation or the post graduation, there you will read the accommodation bill, transactions, and the treatment, accounting treatment. So in this syllabus we are confined to the trade bills. That is the for buying and selling goods is there, and bills is issued. So let's see the advantages of the bills of exchange. These are the various advantages of bills of exchange. Why bills of exchange is used? What are the benefits? The first advantage is it facilitates the trade for the transactions. That means when we are going to purchase the goods from the market on credit, nobody gives us credit, nobody gives, because there is no proof, that there is no guarantee that we'll make the payment, we'll make sure that they will receive the payment. So if there is some valid document, there is certain evidence, then certainly they will give you. So bills of exchange is facilitates for your buying and selling of goods and services, is for the credit transaction, not for the cash transactions. The second one is it is a source of finance for your business. When you are doing the business, immediate cash you request. If you have the bill, you can discount it with the bank. We'll discuss how you will discount it. So that means if the bill amount is, suppose that this bill amount is 50,000 rupees, you can discount it with the bank. So before on 1st January it has been issued, it is 3 months time is there. 3 months after that it should be paid. But before 3 months, immediately after receiving the bills, after accepted the bills by the drawer, you receive the bills and you need immediate cash. That means on 10th January you need cash for your further transactions. So what you do? Now you can do these bills by handing over to your bank, deposit in your bank account, and request to the bank to make the discounting of that bills. The bank will deduct certain charges and give you the balance amount. So that is called discounting of bills. That means on 50,000 they will calculate the market rate of interest and deduct it for that months or that period which they will granted you, gives you credit. So for that period they will deduct the discount, that is called interest charges, and balance amount they will. So the interest charges is 1,000, so rest 49,000 they will pay you immediate. So this 49,000 it helps you for the finance, for doing further transactions. Okay, so this is called source of finance. Then third one is it is easy to recover the amount. The bills of exchange will help to recover easily from your debtor. The debtor cannot avoid it for the making of the payment, bound to make the payments. So it is easy. Then fourth one is it can be endorsed. Endorsed means that can be easily transferred. the bills can be easily transferred from one person to the another persons easily. That means you had, suppose A receives the bills by accepted by B and A can gives it to C. So that is the transfer. That is called endorsement. This is called endorsement by A to C, because C is the creditor, A is the debtor. So A is the creditor to B and C is the creditor to A. So B gives the bill to A and A gives it to C. So that is called endorsement of bills for your payment of your transactions. And fifth advantage is it is a valid evidence of your debt. So it is a solid proof of your evidence of your transactions. Your transaction is proof. There is a accounting always demands the proof of records, the proof of transactions. So this bills of exchange is a proof used for your transactions. Then sixth is there is a certainty to the make payment. There is a sure, 100% sure that your payment will be received. There is no loss of your transactions. Your transaction cannot be forfeited, cannot be bad debt if there is a bills of exchange. And seventh is it is convenient to make means of trade remittance, means for the payment of trading transactions it is a convenient instrument is used. So these are the various advantages of the bills of exchange, benefits of bills of exchange. So let's come to discuss about the second document, that is called promissory note. Promissory note is another instrument which can be used for the credit transactions. Promissory note. What is promissory note? Promissory note is an instrument in unconditional undertaking to promise to make the payment, certain payment. It is not a note, it is not a currency. In the 10 rupees, 5 rupees or the 20 rupees, 100 rupees, 50 rupees, even 2000 rupees, 500 rupees currency, 200 rupees currency notes, you can see there is a written promise to, that is a promissory note. But this currency is not a promissory, this is not a promissory note, this is not a currency note, this is not a bank note, but it is an instrument prepared in writing from promise by some person to make the payment to other persons. Promisor who make the promise, that is called promisor. To whom payment is made, that is called promisee. So there is the two parties are there. So promissory, what is promissory note? So that is another instrument used under Negotiable Instrument Act for the credit transactions. That promissory note, as per the section 4 of the Negotiable Instrument Act 1881, that promissory notes is defined as the instrument in writing containing an unconditional undertaking signed by the maker. Maker means that is the promisor, to pay certain sum of money only to or to the order of certain person or to the bearer of the instrument. That is called promissory note. So as per section 4 of the Negotiable Instrument Act 1881, the promissory note is defined like this. Promissory note is an instrument in writing containing an unconditional undertaking. This is an undertaking, this is an unconditional order. That is the difference between promissory notes and the bills of exchange. This is an undertaking by the signed by the maker. That means who prepared the bill, who prepared the promissory note is called the maker or the promisor, but who prepared the bills is called the drawer or the creditor. So here promisor is the debtor. So who prepared the promissory note is called the debtor, but who prepared the bills of exchange is called the creditor. This is the fundamental difference. So make to pay, promise to pay certain sum of money. That is the signed by the requisite sums. He signed to make certain sum of money to a certain persons or to certain person or to the bearer of the instrument. That means the name of the persons of this instrument will receive the payment, or to some other person you can give the order for the payment. So let's see, that is the specimen copy of the promissory notes. There is 10,000 at the left corner, top, that is left, that is 10,000. Amount will be written, then stamp, then right corner, at the top right corner, that is in place, then the date. This is the date will be written here, the place, this prepared, who prepared. So 2 months after that, I promise to make the payment to Ramesh or to his order a sum of rupees 10,000 only for the value received. So then it is signed by the Rakesh and Sons. He is the promisor and it is signed to the promisee who received the payments. So there are two parties is involved here. One is your promisor, another is your promisee. So here promisor is the debtor. He is the debtor and the promisee is the creditor. That means A sold goods to B. So B is the debtor and A is the creditor. So B is the promisor here. Will be prepare the promissory notes. He will sign here, hand it over to the A from whom he purchased the goods. So A is the seller. So A will receive the payment. So he is the promisee, the payee, or the promisee or the payee, the person who receives the payment. And promisor is the person who makes promise to make the payment. So promisor is nothing but the debtors, and promisee is the payee or the person who received the amount, or he is the creditor. So these are the two parties involved in the instrument. So if there may be some other person may be involved, but there is none other than the two persons is the parties. But in bills of exchange there are three parties are there. So this is the promissory notes. Let's see what are the features of the promissory notes. The first features of the promissory notes is it is an unconditional written undertaking. So promissory notes is an unconditional written undertaking. It is a promise. I promise to make the payment. But it is an unconditional order. It is a written order. It is not an undertaking. It is a written order. But it is a written undertaking. This is the difference. Second is drawn and signed by the maker or the promisor. Promisor already told you that is the debtor who makes the promise for the payment. But bills of exchange is prepared by the maker who is called the drawer or the creditor. This is another difference. Then third feature is specified the payees. That means promisee to whom payment is to be made. So here promisee or the payee is the creditor. So in promissory note the payee is the creditor or the promisee. But in bills of exchange, the persons who receive the payment is the creditor. Here the person receives the payment is also creditor. Then fourth is your specified amount. Amount will be specified. Specified date of payment. The date on which payment is to be done, that is also mentioned in the promissory notes. So these are the 5 features of the promissory notes. Otherwise, the promissory notes is another instrument, negotiable instrument used under the Negotiable Instrument Act 1881 for the making of the success of the credit transactions. So all those benefits are also comes under promissory notes because both the bills of exchange and promissory notes are used simultaneously. The fundamental difference between the promissory notes and bills of exchange is in bills of exchange there are 3 parties: drawer, drawee and payee. Here drawer is the maker, the creditor is the maker, but there is the creditor, but promissory notes is the promisor or the debtor is the maker, and bills of exchange is accepted by the debtor, but the promissory notes does not need any acceptance because it is a promise to make the payment to the creditors. So fourth difference is that it is to be an unconditional order, whereas promissory notes is an unconditional written undertaking. That is the fundamental difference. Otherwise, both the documents are used for the credit transactions. Hope you had understood the basic concepts of the bills of exchange, the fundamental meanings, the basic idea about the bills of exchange and the promissory notes. In the next class, we will discuss about the terms and accounting treatment. Thank you.